Good afternoon, everybody in Luxembourg and abroad. I'm very happy to welcome you for this 12th or 13th live interview, 10 year, 10 minutes with the LPEA. And today we're going to focus on a theme that hasn't been discussed yet, and actually not that much either in the media. We're very pleased to welcome one of our few members at LPEA who focuses on the debt segment of private equity. Hi, Jakob. Welcome from London.
Thank you for having me.
Yes, you're still confined back there, right?
We are, so it's working home since the last 10 weeks, but given living a little bit outside London and more sunshine than normal, I guess we're at least my family, we're better placed than many, but it's obviously been a very difficult time for everyone.
Of course, but you're looking fit, so happy for that, and therefore we can use your brain and pick it on this very still, to some extent, for some of our members, enigmatic market of debt. I've had the luck to know you for many years, and you come with a very high-profile background in the financial institutions, investment banking first, because you were the top boss of FIG and in particular insurance sector at Morgan Stanley for over 20 years. And then we lost touch, if I remember correctly, and I found out a few years back that you actually had started your own fund, to which now you've been doing for 7 years, funding for SMEs in the Nordic countries, including Luxembourg, I should say. Is that correct?
Yeah, Nordic. We say Northern Europe, beer drinking Europe.
That's a good one. But you still drink wine as well. But you're right. We say beer drinking. You've now deployed capital that represents 650 million in AUM across 2 funds. And so you've come through at least 1.5 cycles, and then we are having you today because what's going on is still very much uncertain for most of us. And I would like to ask you questions around this theme, and if we have time to answer questions from the Q&A of our audience, would be fantastic if you could guide us through that, Jakob.
Sure.
Thank you so much. So, everybody knows that the debt market has grown tremendously over the last 10 years or so. What's going on in the debt markets across the board? And as an LP, I have to say I'm of two minds. Some tell me, well, the debt bubble is about to burst and it's high time it did because it's been performing too strongly, too easily with covenant-light type of structures. And others say, no, thank God we have all these debt providers like the private equity funds to shore up mid-cap companies. Tell us how you see the market, please.
Sure. First of all, there's a very big difference between the liquid end of the market, and then there I put high yield, even leverage loans, and clearly the incumbents, which are traditional bank debt. Yeah. So that's sort of one end of the market, and the other end is alternative credit or private credit, private debt, or more specifically direct lending. Direct lending is the largest segment within private credit. Others, very en vogue right now, is obviously distressed, but that jumps up and down. Private credit generally has for sure been the fastest growing alternative asset class, both in quantum of euros and dollars, in terms of growth rate since the global financial crisis. And it's actually been quite a natural reason why that has been the case. On the one hand, from a supply perspective, the European, and we see it already 15, 20 years before in the US, but the European banks are going through not just a cyclical, but a secular deleveraging, meaning that they can hold less loans on their balance sheet relative to the past. Mm-hmm. Therefore, those debts, those credits to companies across Europe have to be financed in one way. For larger businesses, the bond market and the leveraged loan market, and also private credit is available. For smaller businesses, the main alternative that's now starting to grow up is direct lending. And our focus is in the lower end of the mid-market businesses, somewhere between, say, 2 to 15, but in essence, somewhere 7 to 12, 5 to 10, something in that range of EBITDA companies. Yeah, and we do more than Europe and has had a tremendous growth rate over these last few years when we started. Why is it interesting? Then that was your question. It's a very, very stable and defensive asset class. You don't have market-to-market volatility. And generally, therefore, there's no quarterly adjustments unless you have to make provisions, unless you have to make write-downs. And relative to leveraged loans and relative to the high yield bond market, you have much better security package, both in terms of the actual security and in terms of the covenants. And then on top of that, you get a good, stable, ongoing quarterly yield income on your portfolio. So in effect, we're building a loan portfolio over time. If we made 27 investments for Fund 1, and we made about half a dozen now for Fund 2, and ultimately build that over a couple of years, and then you see the runoff of that.
Mm-hmm.
Yeah.
But
So
surely, sorry, Jakob, but surely you left a very high position in investment banking, also as a bank specialist in FIG. Yes. So what did you see back then in the market that you thought you had your space in the sun, your place in the sun as well? Because you know, we know the Apollos, the Oak Trees, the Ares. I mean, they're big guys. But what about Cordet in the lower mid end of the market?
Sure. Yeah, well, so specializing for all these years on financial services, which means the banks of Europe, the insurance companies, and pension funds of Europe. What I just mentioned earlier, it was and is, and was very evident then. There was a supply contraction from banks. And then from every client I heard, ultimately the long-term providers of capital or insurance companies, pension funds, and endowments. And given that was my specialty, corporate credit, that's primarily the biggest asset class that sits on a bank's balance sheet, and is relatively new invention in Europe back in 2012, 2013. I certainly thought it was a unique opportunity for me, given my skill set, to actually do something very different. I spent 22 years at what I think one of the best, but also one of the biggest banks in the world, and starting your own company from scratch and building it really from day one together with a small group of people has been super exciting.
Yeah, I mean, moving from banker to entrepreneur is definitely a big transformation. So congrats on that. And you have now your second fund. I'd like to know about your vision going forward before we move to Q&A. Are you bullish or bearish for that? And what do you think of these people saying, well, actually, it's been too easy, the party's going to be over? Do you have to be segregated in your analysis?
For sure, when it comes to what you mentioned earlier, a covenant light or covenant loose, and maybe some of the terms and returns having been pressured over the last couple of years, already now, just a couple of months into the coronavirus crisis, we can see a reversal of that. That sort of market is repricing. You're seeing it in the public market. You're also seeing it in the private debt market. Yeah, that's point number one. Point number two, it's a day of reckoning for a lot of managers who, frankly, like us, or slightly longer or slightly shorter, have generally been investing in a relatively benign environment, and certainly those that will have portfolio difficulties, we're going to see that now over the next 12 to 24 months.
So it's like a purge time.
Yeah, it is. And ultimately, it will underpin the strategy generally, and it will underpin the quality of the manager. Yes, I would say so far, knock on wood, as much as for sure we have our difficulties. We have 2 or 3, I would say, more complicated situations in the portfolio out of those 27 that I mentioned earlier. And it's not surprising that there are pressure points, and if you have a demand shock, which primarily it's what it is, most people, sometimes the supply chain as well. But when you have that clearly and for an extended period of time, that puts pressure on any company.
What's the lesson you think you'll take from that going forward in your investment strategy and for the segment or the asset class as a whole?
Well, one of the things that we focused on in particular are businesses with very visible contracted revenue. So where clients have prepay early on, or there's a very well analytical approach you can see in terms of the churn ratio every year. So we have an iCloud business that do iCloud storage. It's pretty self-evident that people need it. It's for small corporates, and they have been absolutely fine and frankly even doing better than normal during crises like this. Similarly, On the very, very small scale, we're investing in a payments business, one of my sort of backgrounds from before, out of the financial sector. And they're focusing on online payments. Clearly, that's obviously a benefit, or has benefited them importantly. Yeah?
Sure.
So the more visible, as opposed to lumpy, visible and projectable revenues, that will be the best. Absolutely. And generally, that's how we focused across the industry segment.
It's already Q&A time, and there's quite a few questions for you, Jakob. The first one is, so you are a Luxembourg headquartered fund in terms of your domiciliation. Do you have an office here? What is your plan for Luxembourg? And on the context of Brexit, given the fact that you are based in London, what's going to happen?
Sure. We're onshore structure, which means that the manager, we're based out of the UK in London, and our funds and our all of our different investment vehicles are Luxembourg based. We're a full scope AIFMD manager, and investors, they both like and are very comfortable with Luxembourg as a regulatory venue, and it would be inconceivable for us, I would say, unless something happened in Luxembourg, to change our fund or our investment vehicle venue outside Luxembourg.
What do you mean something would happen? Like
no, let's call it in a scenario where the Luxembourg jurisdiction would drift further away from, and I would say it's inconceivable. Yeah, but what are the alternatives? You could go to Ireland, yes, potentially. Obviously, there are a variety of the Channel Islands or into the Cayman Islands. But I would say investors think, this is our feedback, is that Luxembourg is the preferred location in Europe, and certainly for debt, it's very, very. And
so you will build up your presence here?
Yeah. So then, when it comes to us, we have office in Luxembourg, but we have it via our service provider. We are working with one of the most well-known service providers called Altodomus, and we've had a very close relationship ever since I started the business back in 2013. So they have helped us build out sort of a pay-as-you-go model and helped us build expertise and etc. But as we now increasingly, and I would say when you hit $500 million of invested capital or capital under management, you sort of have to institutionalize the business. You have to bring in your own external directors. You have to insource more activities, and anything from accounting, middle office, risk management, what have you. And that's what I expect as we grow, and as we would over time add persons ourselves in Luxembourg, it would come in that space.
Sure. Another question more on your business again, Jakob, and I hope we see you more in Luxembourg anyway. I know that you've climbed Mount Everest. So when I ask you this question, I feel a little bit silly because, but I still ask it. What has been difficult with the positions that are doing not so well, since after such a challenge, everything seems easy, but let's assume that.
Well, I would actually say that being an entrepreneur and starting your own business is almost a lot harder than climbing Mount Everest. Mount Everest it's a very straight path, and it may be risky at times, but at least you sort of know where you're going and where you're heading. Building a business from that perspective are more sort of twists and turns. But when it comes to portfolio, I think what is harder is sort of the unknown unknowns, the second level of difficulties for businesses. We have one very, very good business. I'm not going to mention the name, but I'll tell you the case study. Profitability, EBITDA, somewhere, let's say 12 to 15 million euro last year. They are in the automotive supply chain. They're based out of Germany. They're delivering 90% to BMW for one of their components that BMW needs. Good owner. And we are this sort of senior lender for that business, together with a German bank as well as a minority lender. But then, we're all sitting in self-isolation. Not many cars are being sold, and not for them doing anything wrong, but the consumer demand is low, and therefore it's a matter of just being able to calculate for how many months do you need a liquidity or extra liquidity to sort of
But so you have to decide if you shore them up or not, or you have to, or you can't.
Absolutely. Yeah. In the first instance, clearly, you go to the owners, yeah, and see what they can do or what they should do. Anyone, and it's not just for that specific company, but for, I would say, for most of our portfolio companies and across industry, people have drawn on their revolving credit facilities just to have cash balances to be able to weather out the storms. Yeah.
So Jakob, two more questions before we let you go. So you raised the fund as a first-time investor to some extent. What did it take to get there? And for those budding PE investor entrepreneurs who would like to launch themselves today in the debt segment, what are the tips you would give them?
Well, I would say that the first dollar is the hardest dollar, or the first euro is the hardest euro, and the situation we are in today, we have a relatively good brand name. I think great even. We're one of the leading companies in what we do in Northern Europe, and business is coming through our door automatically. But when you start, doesn't matter if you have a great CV or don't have a great CV. What investors want to see that you can do and are doing what you said that you should be doing. Therefore, it's very easy to get a lot of meetings, but it's very hard to get early investors to commit. So those early commitments are key and absolutely were the hardest. And I'm happy to spend time with any one of your listeners or members and give them my story on it. But we were supported actually, and that was also very important, by one cornerstone investor, which was actually the British government. They called the British Business Investments, and to them I have a gratitude, and I will continue to have gratitude forever, because they ultimately helped put us in business by being an early supporter of what we do. They do something very similar to what EIF obviously does.
Sure. Okay, so Jakob, when are you going to invest in the Luxembourg SME, and what kind of criteria will you look at?
We will invest happily in a Luxembourg SME. There aren't, in truth, not that many. There are obviously a fair few more in the financial services sector, yeah, and some of the in-business services.
But you'd be surprised, we will show you some really good industrial businesses here that are maybe not on the international scene, although they have obviously an international market. So what are the criteria you would look into? Maybe we have candidates on listening.
On an earnings perspective, EBITDA somewhere between 2 million at the lower, up to 15 million at the higher. It needs to be in a subsector of industries, business services, fintech, healthcare, industrial, or technology consumer, alternative consumer. Those are our 5 industry sectors. And also, at least from our score sheet, any borrower needs to sit on the right side of a set of macro trends, mega trends, and we define them as being a beneficiary of technological change, the network effects in society, urbanization is another important mega trend, aging population, and green tech. And whatever you do, but if you fight one of those bigger trends, let's say climate change, or you fight aging population. By the way, we're investing in a wheelchair business. So for aging population, that sort of scores very highly on that mega trend. Yeah.
Oh,
so you have to fit a geography, Northern Europe. You have to fit one of the 5 industries that we invest in. And then you have to have a positive score on the mega trends.
Does it matter who the shareholders are of the business?
No, it doesn't, in the sense that we are agnostic, but clearly the financial ability and the quality of the owner is important. Private equity, smart people, always. They have money almost always, not always, but almost always. But they also sometimes say, thank you very much, we're going to walk away, even though they've invested. A family-owned business, for generations, they may not have cash, liquid capital to the same extent, but they're much less focused on the top extra dollar of debt or anything like that. They want a long-term financial stable partner, and that's what we provide. So we do both sponsor and non-sponsor.
A structural question to close before asking you for the word of the end. Would you consider an open-ended fund, Jakob?
Yes. Yeah, and I think that certainly in the area where we are and where it's more targeted towards a diversified portfolio and an ongoing quarterly yield. And we tell investors that at a minimum net on any given quarter, 125 basis points, we now deliver 225 basis points per quarter, so around 9% per annum.
Mm-hmm.
So it's an income product, yeah, and it's a capital preservation income product. And you now start to see examples. It's not a hedge fund structure, but something similar where you have to give 6 to 9 months ahead warning that you want to exit, and then someone else can buy in at whatever at point.
So you're looking at it for Cordet, although you haven't done it yet.
We certainly feel that as a technology, it makes a lot of sense to do it, especially in the area where we are. But I would say an Apollo or an Ares are probably better to open that market up in Europe, and were they to do so, being the two of the largest companies in the world in this area, then certainly we would follow. Yeah, because ultimately it's pretty inefficient. We invest within 3 years investment period, as much as the loans are anywhere between 3 to 6 years on average. The loans are outstanding for 3 years. So we got to come back to investors every 3 years.
Yes.
And it takes a fair bit of time on our side, investors the same, and ultimately they want to have a good diversified, lower risk credit portfolio that gives you an illiquidity premium and a good return per turn of leverage. And the lower mid-market certainly has a very attractive risk reward.
So let's see who opens the conduit of open-ended funds.
Thank you.
So Jakob, the word of the end.
Yes.
Tell us something that we can relate to our community, and remember that we can replay this video over time, and we will look for you to send us your best of during the course of June. So
well, we haven't closed. We would be happy to invest anywhere in Northern Europe, including Luxembourg. And we only see actually that the business opportunity is much greater today than it was 3, 6, 12 months ago, because of that the bank's retrenchments is only going to be much, much more sudden. And therefore someone else has to replace the bank debt provided, and alternative credit providers such as ourselves are a very unique way of doing it to access this market.
Good words of wisdom. Thank you, Jakob. I just want to say to our audience that the next time we are online, beside the technical webinars, is to support local artists who lost their income because of COVID-19. And so maybe, Jakob, if you have nothing to do at 5 p.m. London time next Tuesday, you can tune in and donate to our next artist, who's called Yasha Zare. But meanwhile, we hope to welcome you back in Luxembourg soon. And, you know, we have already flights to Stockholm from tomorrow.
Okay, so, good. Okay, well, London is a bit later, so coming later. Well, thank you for having me.
Yes, take care. Thank you.